All right, we kind of mentioned about our interest capitalization. So when considering capitalizing interest, we need to answer three questions. Which assets are qualifying assets? So, if it's an asset you can't capitalize interest on, obviously that'll eliminate that. What's the capitalization period? Well, that is going to be basically the construction period or when you're getting it installed. What's the amount of interest to be capitalized? All important questions to be asking. Capitalizing interest on qualifying assets. Let's start digging into those rules. Well, there are two types of qualifying assets. Assets under construction for use in operation. So this is more commonly tested in the exam. And discrete assets intended for sale or lease. Let's focus more so on number one. So if you're constructing something, like I said, it's basically you're going to capitalize that interest while it's being constructed. If you pause construction, you pause capitalizing, and any interest incurred is going to start being expensed. And then when you start constructing again, you are going to capitalize. They must require a period of time to make them ready for use, right? Like we were saying, it's going to be over the period that you are doing the constructing. The capitalization period. Now, here's a graphic I stole from myself from the chapters on research and development and software costs. They have the same concepts of capitalizing versus expensing. Definitely something to know, right? So learn it here. So it's really in your mind for when you see those. But it's the same concept. Capitalization of costs begin when expenditures for the asset have been made. So basically, once you really start, like it's you can prove that you've committed to really starting the project. Activities for readying the asset are in progress and interest costs are being incurred. So if I'm building a building, I can't start capitalizing until I've started to, spend money to build the building, and we're actually sending workers out to build it, and we actually have interest costs being incurred. Capitalization period ends when the asset is pretty much complete, right, and ready for its intended use. And like I said, similar concepts as software costs, capitalizing versus expensing, slightly different. There'll be questions in the exam. So if we have a worker strike, or if we just pause construction because costs are too expensive, then we cannot capitalize interest anymore. We're going to be expensing it. It's kind of like a start, stop, right? Just a process when we can capitalize interest. Remember, capitalizing good, expensing bad. It's more complicated than that. Not more complicated. It's just not really that, but that's how I like to remember it. And, it's a helpful process. If I was a business, I'd want to capitalize rather than expense. Capitalization amount. Well, answering all those three questions, what do we capitalize? We capitalize the lesser of the actual interest costs or the avoidable interest. So what is avoidable? Obviously, actual interest costs is what actually is incurred. Avoidable interest is the amount that could have been avoided if expenditures for the asset had not been constructed. You'll be given these numbers, right? You'll basically just choose between them. You have to calculate actual interest costs, but you'll probably be given the avoidable interest, and you'll just determine that. All right. Well, computing avoidable interest, if you're not given that, how are we going to do that? We determine the weighted average accumulated expenditures, which, just like any other weighted average, we are going to time weight those expenditures times the appropriate interest rates. That gives you the avoidable interest. And then, like we said, we capitalize the lesser of avoidable and actual interest.